Who wouldn't want to shop for clothes if there's a discount festival on Amazon or Myntra? Similarly, imagine what if there's a sale on the stock market? What if you get to buy some good stocks at a discount? So what does it mean by getting a stock at a discount? Well, simple. Just like when you get a t-shirt worth 3,000 for 1,500 at 50% discount, when you get a good stock at a lower price than what it is worth for, that stock is called as available at a discount, or what we call it as an underpriced stock. And a stock which is available at a price more than its worth, it is called as overpriced stock. But remember, not every stock which is underpriced may be worth your consideration. Only good stocks which, like maybe due to some temporary issues, are priced lower than their worth need to be considered. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of personal finance. In this video, we'll discuss 5 ratios which can help you identify whether a stock is underpriced or overpriced. So number 1 is the most popular one, price to earnings ratio. PE ratio is a simple yet powerful metric that tells you how much premium you pay for every rupee of earnings from that company. The mathematical formula to derive the PE ratio is current share price divided by earnings per share. Now, earnings per share is derived by dividing net profit excluding the dividends paid by the total number of outstanding shares. Suppose the stock of company X is trading at 1,500 and its EPS is 85 rupees. The PE ratio comes out to be 17.64, meaning you are paying 17.64 rupees for every 1 rupee of earnings from that stock. Now, looking only at the current PE ratio does not reveal much about whether the stock is expensive or inexpensive. You have to look at the long-term historical PE averages, say 5 years or 10 years. The data is easily available on the internet. Here we'll be looking at Infosys. We'll use year 2023 data for illustrative purposes here. So its PE as on March end 2023 was 24.52, and the long-term historical PE average for 5 years, the median PE is 26.4, and for 10 years the median PE is 20.6. Now let's compare the PE ratio of Infosys with its peers. Look at your screens. So going just by PE ratio compared with historical averages and peers, Infosys may look slightly overvalued. Let's look at other ratios as well. So next is price to book ratio. Now PB ratio compares the share's market price to its book value. The book value per share of the company is assets minus liabilities divided by the total number of outstanding shares. And PB ratio is market price per share divided by book value per share. Now, if the current share price of a company is more than its book value, then we can say the stock is overvalued. So suppose for stock X, the book value is 212 rupees and the share price is 1410 rupees. The price to book ratio comes to be 6.65, meaning that the stock is overvalued by 6.65 times. Now, while a PB ratio closer to or less than 1 is desirable, it may also indicate that investors are not happy with the growth prospects of the company. Hence, stock price has taken a beating. So when analyzing the PB ratio, it is also important to do a comparison among the peers. So let's compare the PB ratio of Infosys vis-a-vis its peers. So going just by PB ratio, we can see Infosys looks slightly overpriced as compared to its peers. Next, we have the price to sales ratio. Now this ratio is very similar to the PE ratio. Instead of earnings, we'll compare the price of the stock relative to the company's sales or revenue. A lower PS ratio potentially indicates that the stock is undervalued and vice versa. Now, like the PE ratio, this ratio should be compared with industry peers to get a better idea of the valuation. Moving to the next metric, dividend yield. Dividend yield is the financial ratio that shows how much a company pays out dividends to its shareholders each year relative to its stock price. The formula is annual dividend per share divided by price per share. Now you can look at the dividend yield ratio in 3 ways. First, if the stock has a high dividend yield, it could indicate that the stock is undervalued or that the stock's price has dropped due to challenges in the business. Second, if the stock has a low dividend yield, then it could indicate that the stock is overvalued. Some growth companies have low dividends as they prefer to reinvest profits back into the business rather than paying out dividends. And third, some companies have zero dividend yield, meaning they don't pay dividends. In such case, you need to look at other valuation metrics to evaluate the stocks. So let's again go to our Infosys comparison with its peers. The data is on your screens. So as you can see, the dividend yield of Infosys is on a lower side as compared to its peer set. This again indicates that the stock is overvalued. Moving to our last metric, that is price earning growth ratio. Till now, all the ratios that we have discussed are based on historical financial data. Now we'll discuss about price to earnings to growth ratio or PEG ratio, which is a forward-looking ratio and is based on company's expected growth. The PEG ratio adjusts the traditional PE ratio by taking into account the growth rate in earnings per share that are expected in the future. It is calculated by dividing the PE ratio by annual EPS growth. If the PEG ratio is less than 1, it typically indicates that the stock is undervalued given the earnings growth potential, and the market has not fully factored in the potential earnings growth into the stock price. If it is equal to 1, then it means the stock is fairly valued, and if the ratio is more than 1, it means that the stock is overpriced. Now, there is one limitation of the PEG ratio. It is calculated assuming that the earnings growth rate is constant, which rarely is the case. Also, the growth rate one expects may be different from the kind of growth the other person sees in the earnings of that company. So, there may not be one PEG ratio for a stock. It may differ depending on the growth rate assumed. Now, these 5 key metrics serve as a comprehensive guide to stock valuation, enabling you to avoid overpriced stocks that may yield lower returns in the long run. But remember, look at these ratios plus try to understand the reasons and look for any specific event happening in the company. It may also be a great factor in the price fluctuation of a stock. And this is a wrap. Don't forget to like and subscribe to our channel and also hit the bell icon to never miss a video from us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.